$5,130. That is the price of one single ounce of gold as of this weekend, February 22nd, 2026. 1 year ago, it was sitting at just over $3,000. That's a 74% move in 12 months. And if you think that's just investors chasing a shiny rock, I need you to stop what you're doing and pay very close attention to what I'm about to walk you through. Because that price is not random. That price is a signal. A signal being sent by 46% of the world's population, nations that produce 37% of global GDP, and they are in the middle of executing the most significant challenge to the US dollar-dominated financial system since 1944. BRICS. 10 full members now. Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Indonesia, Iran, and the United Arab Emirates. And on October 31st, 2025, they quietly launched something called the unit. Not a concept, not a proposal, an actual working prototype of a gold-backed digital trade currency built on the Cardano blockchain, with 100 units already issued, each one pegged to 1 gram of gold, backed by a reserve basket that is 40% physical gold and 60% BRICS national currencies. And by the end of this video, you are going to understand exactly why that 40% figure is one of the most important numbers in global finance right now. Not because of what it is today, because of what it tells us about where this is going. Let me give you the full picture of what we're dealing with first, so you understand the scale of this. The SWIFT payment network, the system that processes the overwhelming majority of international bank transfers, the backbone of global dollar trade, connects over 11,000 financial institutions across more than 200 countries. It is the plumbing of the dollar system. And for decades, Washington has understood that controlling SWIFT is essentially controlling the global financial conversation. You want to sanction a country? Kick them off SWIFT. You want to freeze someone's access to their own foreign reserves? SWIFT makes that possible too. Russia learned this lesson hard in 2022 when they were cut off. Iran has lived under that reality for years, and every BRICS nation watched those moves very carefully. What they concluded was this: if your economic survival can be switched off by a decision made in Washington, you are not truly sovereign. And they started building a way out. Now, I want to be precise here because there's a lot of noise around this topic, and I'm not going to add to it. Russian Foreign Minister Sergei Lavrov said it himself: no one in the BRICS community is raising the issue of replacing the dollar. And Leslie Mosdorp, CFO of the new development bank, the BRICS Bank, told Bloomberg directly that there is no formal plan for a unified BRICS currency as of right now. So anyone telling you the dollar dies next Tuesday is selling you something. That is not what this is. What this is more subtle and in many ways more consequential. What BRICS is building is an alternative settlement rail, a way to conduct trade between member nations without touching SWIFT, without needing dollar clearing, without exposure to US sanctions. And crucially, they are backing it with gold. The 17th BRICS Summit, held in Brazil in July 2025, produced concrete agreements to build digital payment infrastructure and expand bilateral trade using local currencies. China's cross-border interbank payment system, CIPS, now connects nearly 5,000 banking institutions globally. That is the parallel plumbing they are constructing, and the unit is the value anchor that sits on top of it. Quick note to those who aren't subscribed yet. My analytics show roughly 3 out of 4 people watching this aren't subscribed. If this kind of analysis, based on actual data, actual summit agreements, actual price movements, is cutting through the noise for you, hit subscribe. That's how I know who the serious people are in this community. It helps me, and it helps the algorithm get this in front of people who actually need to see it. Now, back to the unit. Because here's what makes this structure genuinely fascinating. The 40% gold backing isn't arbitrary, it's strategic. Think of it like this. The dollar hasn't been backed by gold since Nixon closed the gold window on August 15, 1971. That was the moment the global monetary system went fully fiat, fully backed by nothing but trust in the United States government and its economy. And for 50 years that worked, more or less, because the US was unquestionably the world's dominant economic and military power, and because oil was priced in dollars, creating constant structural demand for the currency, regardless of what Washington did with its own finances. But the US national debt is now sitting above $36 trillion. The Federal Reserve has kept rates at 3.5 to 3.75%, with 92.1% of market participants, according to CME Group data, expecting no cut even in March. and the dollar's share of global foreign exchange reserves has been declining, slowly but steadily for years. What BRICS has done with the unit is say, we'll anchor our settlement currency to something you can't print: gold. Specifically, 40% of each unit is backed by physical gold stored within member countries' own borders, in escrow accounts on the mBridge ledger. It doesn't get shipped to a central authority. It doesn't leave the country. It just gets committed as collateral. That is elegant. That is a system designed by people who have thought very carefully about how to make this impossible to sanction. Now, let me give you the historical pattern here, because this exact dynamic, an emerging power challenging the reserve currency of a declining dominant power by reintroducing gold discipline, this has happened before. Let me show you 3 times. First, 16th century Spain. Spain controlled the largest empire on earth and used silver from the New World to dominate global trade. For about 150 years, the Spanish real was essentially the world's reserve currency. But Spain kept spending: wars, royal debt, imperial overstretch, and the silver flooded the market, creating inflation, eroding confidence. The Dutch Republic, smaller, more disciplined fiscally, built their own trade network with the Amsterdam Wisselbank in 1609, the world's first central bank, and started offering something Spain couldn't: reliable, trustworthy settlement. By the mid-1600s, the Dutch guilder was the world's dominant trade currency. Second example, the British pound. For 2 centuries, sterling was the global reserve, backed by gold through the gold standard, administered through the Bank of England, and enforced through the largest navy and empire in history. But 2 world wars broke Britain. The debt was catastrophic. The pound's gold backing was suspended, restored, suspended again. Meanwhile, the United States, disciplined, industrial, creditor nation, had accumulated most of the world's gold, and in 1944, at Bretton Woods, the world formalized what was already obvious. The dollar, backed by U.S. gold reserves, replaced sterling. Britain didn't agree to this happily. It happened because the math was undeniable. Third, the dollar itself in the early 1970s. By 1971, the U.S. was running trade deficits and funding the Vietnam War through deficit spending. Foreign central banks, led by France, started demanding gold for their dollar reserves. Nixon closed the gold window rather than let the Fort Knox vaults drain. The dollar survived, but only because Henry Kissinger brokered the petrodollar deal with Saudi Arabia, ensuring oil would only be priced in dollars globally. That move bought the dollar another 50 years of dominance, but it did not fix the underlying problem. It just delayed it. Which stage are we in now? We are in the stage where the challenger is laying pipe. The Dutch laid their banking infrastructure before they challenged Spain. The U.S. laid Bretton Woods before the pound fell. BRICS is laying mBridge, CIPS, and the unit right now. And you need to pay attention to how fast this is moving. Let me pile on the data here, because this is where it gets undeniable. Central banks, the people who manage the actual reserves of nations, have been screaming this story through their purchasing behavior. In the second quarter of 2025, global central banks purchased 166 tons of gold. That is a 41% increase above the average quarterly pace. For all of 2025, according to World Gold Council data, central bank gold purchases totaled 863 tons. To put that in context, pre-2022 central bank buying was running around 400 to 500 tons per year. They have roughly doubled their pace of accumulation. Total global central bank gold reserves have now surpassed 36,000 tons. BRICS countries have expanded gold's share of their total reserves by 102% since 2020. The central banks within BRICS member states accounted for more than 50% of all global gold purchases between 2020 and 2024. And as of September 2025, BRICS gold reserves increased by 129.7 tons in a single quarter, reaching 145.1 tons just for the bloc's combined additions. These are not small numbers. This is coordinated accumulation. China's central bank, the People's Bank of China, extended its gold purchases for the 15th consecutive month in January 2026. 15 consecutive months. That is not a hedge, that is a strategy. And the PBOC isn't alone. This is happening across the bloc. Now stick with me, because here's where it gets truly interesting. BRICS nations are not just buying gold, they're controlling it from the source. China's gold production came in at 380 tons in 2024. Russia produced 340 tons. When you add in strategically aligned nations, Kazakhstan, Iran, Uzbekistan, the combined output of BRICS-aligned states accounts for approximately 50% of global gold mining production. And according to analysts at Ya Wealth, Those same nations are both producing more and selling less into the open market. Think about what that means. If you control half of the production and you're buying instead of selling, and you're using that gold to back a new settlement currency, you are creating a structural floor under the gold price that is disconnected from what happens on COMEX in New York or on the paper futures markets. And that is exactly what we're seeing in the price. Gold at $5,130 per ounce as of this weekend is not being driven by retail investors or ETF speculation alone. According to JP Morgan Global Research, and I want to be clear, this is JP Morgan saying this, not some perma-bull on the internet, they forecast gold prices averaging $5,055 per ounce in the final quarter of 2026, rising toward $5,400 per ounce by end of 2027. They describe the trend driving this as, quote, a rebasing higher that is not exhausted. They expect around 755 tons of central bank purchasing in 2026 alone, still historically elevated even as a step down from the last 3 years. Now let me show you the disconnect that nobody's really talking about in the mainstream media. The Federal Reserve is holding rates at 3.5 to 3.75%. U.S. GDP in Q4 grew just 1.4% annualized, significantly below the 2.8% that was expected. The U.S. Supreme Court just struck down Trump's global tariffs, a move that will boost the U.S. budget deficit further because that tariff revenue vanishes. The dollar index actually fell from a 4-week high on Friday as a result. U.S. Q4 core PCE, the Fed's preferred inflation measure, came in at 2.7%, above the 2.6% expected. So you have slowing growth and sticky inflation simultaneously. That is stagflation territory. And the Fed is stuck. They can't cut aggressively because inflation won't cooperate, and they can't raise because the economy is already weakening. Meanwhile, over in the BRICS settlement system, every gram of gold in that unit reserve is worth considerably more than it was 12 months ago. The architecture of the unit, where its value is adjusted daily based on the gold price, means the bloc's reserves are appreciating even as Western fiat currencies navigate this pressure. The unit was initially pegged at 1 gram of gold per unit when the pilot launched. By December 4, 2025, market fluctuations had already adjusted the backing to 0.9823 grams. The basket value moved with real gold market dynamics exactly as designed. Here's what I want you to understand about the mechanism, because this is the part that most commentary misses. The unit is not designed to replace national currencies. It's not asking China to give up the yuan or India to surrender the rupee. What it does is provide a neutral settlement rail between them that nobody can switch off. Andy Schechtman, president of Miles Franklin, explained this clearly in a July 2025 interview with the Investing News Network. The gold backing comes in the form of kilo bars, and those bars are deliverable and redeemable for participating entities. The gold sits in escrow within each member country's own borders. It gets placed onto the Enbridge ledger off of the nation's normal balance sheet. No central authority holds it. No single point of failure. No sanctions lever. This is the fundamental difference from how SWIFT operates. SWIFT is centralized enough that Washington can lean on it. Enbridge, the blockchain infrastructure BRICS is building the unit on top of, is explicitly designed to remove that choke point. When Dilma Rousseff, president of the New Development Bank, publicly confirmed the agreement in principle to use the unit as a settlement currency backed 40% by gold, that was not a press release from a fringe institution. The New Development Bank has nearly $100 billion in approved financing. These are serious people with serious resources executing a serious plan. Now, BRICS currently plans to expand its gold control from roughly 50% of global production to somewhere between 65 and 70%, according to reporting from Watcher.guru in January 2026. That's being driven by continued central bank accumulation and the expansion of BRICS membership. The bloc went from 5 to 10 full members and continues to add partner nations. Several African governments have already signaled interest in alternative settlement systems outside the dollar. If you are a nation watching Russia get its $300 billion in frozen foreign exchange reserves weaponized against it in 2022, you are thinking very hard about how much dollar-denominated paper you want sitting in your own vaults. Gold in your own borders, in your own custody, that's a different story. Short-term gold lease rates have moved to 9.4% according to market data. Silver lease rates spiked to 6.5%. Those numbers indicate stress in the physical supply chain. Institutions that need physical metal are paying through the nose to borrow it. This is not a paper market phenomenon. This is real physical demand creating real physical tightness. The exchange for physical premium in silver hit 92 cents per ounce at peak periods. These are the pressure gauges showing you the physical market is running hot. So who are the names you need to watch? JP Morgan, as I mentioned, is now projecting gold at $5,055 per ounce by late 2026. That's their official research desk. BlackRock's gold ETF positioning has been consistently long, but the real institutional action is happening in sovereign wealth funds and central banks, particularly in the Middle East. The UAE is a full BRICS member as of 2024. Saudi Arabia is a BRICS partner nation. These are petrodollar countries, the very architecture of the petrodollar deal that saved the dollar in 1974, and they are now at the table for a gold-backed settlement alternative. That is not a coincidence you can wave away. The BRICS summit in India is scheduled for 2026. This is where the next formal steps on the unit's rollout are expected to be discussed. The pilot has already been running since October 31st, 2025. The blockchain is built, the escrow architecture is designed, the gold is being accumulated. The question is not whether this is happening. The question is, at what pace, and what it means for the purchasing power of the paper in your wallet. Now let me make this real and personal for you, because what's the point of understanding all of this if we don't connect it to your actual financial life? And I want to be very clear, this is not financial advice. I'm not your advisor, I don't know your situation. Consult a qualified professional before making any financial decisions. What I can do is walk you through the logical implications of what we've just covered. First implication, the gold move we've already seen may not be the end of the move. When JP Morgan tells you $5,400 by end of 2027 and gold is already at $5,130 today, that's not a massive percentage gain from here compared to where we've come from. But understand the structural reason the price keeps getting bids underneath it. Central banks don't sell into weakness, they buy into it. That creates a floor that retail sentiment or hedge fund profit-taking can't easily break through. The 863 tons of central bank purchases in 2025 absorbed supply that would otherwise have pressured the price lower. Second implication, the dollar's reserve currency status is not a binary on-off switch. It erodes gradually and then suddenly, to paraphrase Hemingway on bankruptcy. The dollar's share of global foreign exchange reserves has been slowly declining for years. Each bilateral trade deal done in yuan or rupees instead of dollars is one less structural source of dollar demand. It happens at the margin, then it compounds. The question for your savings, your wages, your long-term financial planning is whether you are positioned for a world where that erosion continues, or whether you are assuming the status quo is permanent. Third implication, U.S. fiscal trajectory matters here enormously. With tariff revenue gone after the Supreme Court ruling Friday, with GDP growth at 1.4% and inflation sticky at 2.7%, the structural pressure on Washington's budget is building, not easing. More debt, higher interest costs, slower growth. This is the same cocktail that preceded every reserve currency transition in history. It doesn't mean the dollar collapses tomorrow. It means the trajectory is meaningful. Fourth, SWIFT is not going away overnight, but its monopoly is cracking. China's CIPS now connects nearly 5,000 institutions. The unit adds a gold-anchored settlement layer on top of that. Every transaction that routes through mBridge instead of SWIFT is a reduction in dollar velocity globally. Again, gradual, then sudden. Fifth, physical gold versus paper gold. The gold lease rates hitting 9.4% tell you something specific. The paper market and the physical market are not in perfect alignment. If you own a gold ETF, you own a claim on gold held in trust by a financial institution. If that institution faces stress, your claim faces uncertainty. Physical gold in your possession, or in allocated vaulting, doesn't have a counterparty risk. In a world where BRICS is specifically designing a settlement system to eliminate counterparty risk through decentralized custody, that philosophy is worth thinking about for your own holdings. Sixth, watch the India BRICS summit later this year. This is the scheduled venue for the next major formal steps on the unit. Any concrete announcement about an expanded pilot, about additional member nations joining, about formal trade settlements being denominated in units, that is a price-moving event for gold. You want to be aware of that calendar. Seventh, and finally, this is a process, not an event. Nobody is pulling a lever on a specific date and resetting the global monetary system to gold. What is happening is a slow architectural shift where the nations holding most of the world's physical gold and producing most of the world's new gold supply are building the infrastructure to conduct trade in a system where their gold matters. That process rewards people who have positioned accordingly. It does not reward people who wait for the headline that says it's officially over. Let me bring this full circle because I want you to remember where we started. $5,130 per ounce today, February 22nd, 2026, up 74% from a year ago. JP Morgan, the largest bank in the United States, saying it goes to $5,400 by 2027. Central banks buying 863 tons in 2025 alone, more than double their pre-2022 pace. BRICS nations controlling 50% of global gold production and targeting 65 to 70%. The unit, a 40% gold-backed digital settlement currency, running on a live pilot since October 31, 2025, built on the Cardano blockchain, with 100 units already issued, and the full BRICS architecture behind it. The narrative you'll hear in mainstream financial media is that this is a distant threat, that the dollar is safe, that BRICS countries can't coordinate effectively, that the unit is just a research project. And there is truth in some of that. The unit is still a pilot. The BRICS countries do have internal tensions. India runs a $60 billion trade deficit with Russia, which complicates currency settlement. China and the US are still negotiating the structure of a massive tariff arrangement. These are real complexities. But here's what I want you to hold on to. The people before, the ones holding Spanish reals when the Dutch were building the Wisselbank, the ones holding sterling bonds when Bretton Woods was being negotiated, the ones who dismissed Nixon's gold window closure as a temporary measure, they didn't see it coming until it was already done. The signs were there, the architecture was being built, the gold was being accumulated, and by the time it was undeniable, the optimal positioning window had already passed. I'm not saying be in a panic. I'm not saying sell everything you own. I'm saying understand what is being built, understand the historical pattern it fits, and make thoughtful decisions about how you are positioned for a world where the 80-year post-Bretton Woods dollar order faces a serious structural challenge for the first time. That's all I'm asking. The data is documented. You can verify the World Gold Council's central bank purchase numbers directly at their website. The BRICS unit pilot information is published by IRIS, the International Research Institute for Advanced Systems. JP Morgan's gold price forecasts are on their public research platform. The CIPS connection numbers come from the Chinese financial system's own published data. None of this requires you to trust me. It requires you to look at the sources, do the math, and decide what you see. Drop a comment below. I want to know this. Are you positioned in any physical gold or silver right now? And if not, what's the single biggest thing stopping you? Is it price? Is it storage? Is it uncertainty about how to actually buy it? I read every comment, and your responses genuinely shape what I dig into next. This community drives this channel. And if you want to go deeper on this, I did a full breakdown recently on why central bank gold reserves have been quietly repatriated from Western vaults over the last 5 years. Germany, the Netherlands, Hungary, Poland, all pulling gold back home. That video ties directly into everything we just talked about. Watch that next. Subscribe if you haven't already, and I'll see you in the next one.